Cameron May. I'm a Senior Manager of Trading and Derivatives Education here at Schwab, and this is Getting Started with Options. And the markets have had a great run over the last 12 months, kind of softened that bullish run just in the last 2 months. And some traders look for short-term windows of opportunity, even within a bullish month, to place a quick bearish trade. That's what we're going to be talking about today. We're going to be talking about a 1-week strategy for trading quick pullbacks, weighing the pros and the cons. A lot to cover there. Before we get to any of that, though, let me first of all say hello to everybody who's already chatting in out there in YouTube. Great to see everybody. Hello to the familiar returning veterans. Hello to anybody that might be new. But let me say hi to everybody in particular. Hello there, Will and John and Bogus Chinchilla, good name. Jay Richardson. We have Zinc and Teach to Fish too, and Roderick and Richard, everybody else. Thanks for joining us week after week. We always appreciate your attendance and your contributions to these discussions. If you do happen to be here among those who are here for the very first time, I want to welcome you as well. And if you're watching on the YouTube archive after the live stream is concluded, enjoy the recording. It's a great way to watch these webcasts. But if you'd like to be here in our live stream audience, you're certainly invited to join us. This is a Tuesday webcast series. We kick things off promptly at noon Eastern time. Now, I also want to let you know that my very good friend Kevin Horner is hanging out in the chats in YouTube right now. He's keeping an eye on any questions that come in. If I can't get to those, Kevin's there to pick up my slack. I've been working here with Kevin for years. Great to have you here, Kevin. And Kevin and I would also like to issue an invitation to everybody watching to follow your favorite Schwab presenters on social media. You can find and follow us on X or on LinkedIn. You can find Kevin on X at Kevin Horner CS. You can follow me on X at Cameron May CS, or if you can pop over to LinkedIn, just go to linkedin.com/in/Cameron May CS. But let's get into this discussion. And as we do, of course, there are going to be risks associated with the example strategy that we're demonstrating today. So bear these important disclosures in mind. The information here is for general informational purposes only and should not be considered an individualized recommendation or endorsement of any particular security, chart pattern, or investment strategy. Options carry a high level of risk and are not suitable for all investors. Schwab does not recommend the use of technical analysis as a sole means of investment research. Investing involves risks, including a loss of principal. Short options can be assigned at any time up to expiration, regardless of the in-the-money amount, and any investment decision you make in your self-directed account is solely your responsibility. All right, so let's just revisit what we're going to cover today. We'll set a quick agenda. Today, I wanted to take a quick look at what the markets have been doing over the last 12 months and use that as a backdrop to get in the mind of a trader who might be looking for short-term bearish opportunities in what has been a fairly persistent bullish market. So today we're going to be structuring what we call a bearish vertical spread, and we're going to do that so that we're going to specifically design that so we have our answer very quickly, whether it works or not. This is going to be a trade that plays out entirely within 1 week. So it should be an interesting discussion. We'll talk about how a trader might structure a bearish trade within a bullish market for quick pullback conditions if they play out. And we'll be planning on placing that example trade in our paper money portfolio today. So let's go right to it. Let's have a look at what's been going on with the S&P. I've already hinted at what's been happening over the last 12 months, but here's a quick recap. Yeah, we had a nice run starting 12 months ago, leading up to just exactly 1 month ago. If we look at this little peak we hit right here, that was May 14th. As of the recording of this webcast, it's July 14th. What has the S&P done in that 2-month period since then? Well, it's been down, it's been up, but overall, pretty much sideways. As a matter of fact, if you look at today's low, we reached down to 75.13 on the S&P. And if you look at the high from May 14th, 2 months ago, we reached as high as 75.17. There is overlap from today's trading stretching back 2 months. Not a lot net accomplished. So that doesn't necessarily mean, though, that there isn't always opportunity within the markets. Now, obviously, not every perceived opportunity works out, but let's say that we are that hypothetical trader who sees things going sideways. Yep, Jay Richardson kind of sliding sideways over the last 2 months. And maybe we note that we've been bumping our heads up against this 7,600 price level or value level. And let's just say that our trader doesn't know, maybe stocks go up from here, maybe they go down from here, but what they're really just looking for is for the stocks at least not to rally too sharply for just one more week. Can this ceiling hold for just one more week? That could be the premise of the trade. Now, they might feel a little bit better for the way we're going to structure our example trade today if stocks actually retreated a bit and did pull back. But really, we're going to set up a trade that is structured to benefit as long as stocks don't rally above price ceilings for just a little bit longer. We've been going for 2 months. Let's see if we can go for one more week. So we're going to set up a trade today that's going to go actually just beyond this Friday, this July 17th line that shows us the Friday expiration. We're going to be setting up a trade for Monday. There are some stocks out there with options that trade Monday, Wednesday, and Friday. So let me show you where I found today's example stock before I go to it. I actually did a quick review of S&P 500 component companies. So over here in the gadgets, we're going to open up a watch list. And I've just gone to the public watch list for the S&P 500 component companies. This is a watch list that Thinkorswim maintains, and they publish it for quick access. So here we're looking at the S&P 500 component companies. There are their symbols, and I have 3 custom columns that I've added to this watch list. So to customize our column set, we click on little gear, choose Customize, and we just choose columns. And these are the 3 columns that I have: market cap, last, and percent change. So we can just look those up, like market cap, choose it, and add it. And that'll put it over here in our column set. We just repeat that with last and percent change. But market cap, when a trader, and we'll see a good example of this in just a moment, when we're trading very short-term options, the bid-ask spread can really come into play quite a bit. If there's a big difference between the bid price and the ask price, if there's liquidity issues, that liquidity issue can really be emphasized by short-term contracts. All right, so a quick way to address liquidity issues like a wide spread between the bid and the ask is to look at stocks that are heavily traded. And the largest companies in the world, or the most heavily traded companies in the world, we're going to sort here by market capitalization. Next up, traders frequently want to keep an eye on the price of the stock. Pricier stocks tend to come with us when we trade the options on those. They come with larger obligations. So we'll keep an eye on the prices, but also on what the stock is doing today. For someone who is trading and trying to hit a narrow window, they may want to see momentum on price already moving in their intended direction. So if we're looking for a stock to stay at or below a certain level, or preferably going lower, maybe that trader's looking for the stock to already be heading down. And so adding that percent change, we can just look to see, well, NVIDIA is actually up today. So this is interesting. This is the trade that we took yesterday when prices were down. We took a bullish trade in yesterday's webcast. That's going well so far. But let's move on to Apple. Apple is dropping about 1% today. And so let's say that aligns with the premise of our traders' desired strategy that they're trying to set up. They see that markets are kind of bumping against a potential price ceiling. Maybe they're looking at stocks that are bumping against potential price ceiling. So let's look at just the last couple of months again with Apple. Apple, yes, has had a great run over 12 months, but over this last 6 to 8 weeks, not as much. Let's zoom in on this time frame. And what we may notice, I've drawn in a line here at the 317.50 level. Let's look at how high Apple has stretched on a few occasions here. So back here on June 3rd, we got up to a high of 316.94, a little bit short of this line. Here we got up to 317.40, again, right at that line of 317.5. Here's the one example in Apple's trading history where we got up above 317.5, and we quickly faded within the same trading session and we closed at 317.31. So there has not been a single day where we've closed trading above 317.50. For today's example strategy, that's going to be an important point, because what we're going to do is try to set up a trade that will benefit as long as Apple doesn't close above 317.50 on or even potentially before next Monday being July 20th. So that's this line that I've drawn in here. So a couple of reference points. What we're going to have for this trade is a preference to stay below 317.50. How about we just put in a box starting from today up to 317.50. This is where we'd like to be, anywhere down here. And actually, the further down here we go over the next few days, maybe the better this trade is going to feel for the trader. So the preference is for the stock to go down or at least stay below 317.50. Now, that may be adequate. So one thing that a trader who is trying to trade a narrow window might do is just bring up, let's say, a daily chart and look at what's been happening over a recent time frame, see if there appears to be a price ceiling, and that may give them a feel for maybe that stock will stay below that price ceiling for a little bit longer. Certainly not a guarantee. It can certainly rally up above. That's always a possibility. But with such a narrow time frame, maybe they want to take a closer look still to see if things on maybe even an hour-by-hour basis are kind of moving in the intended direction. Let's go see. I don't know. Let's go have a look at Apple. I'm going to switch up our time frame here. Come up here to where it says D for day. Let's go to the time frame subtab. Let's look at an intraday basis. And how about we look at a 30-day chart over just maybe, let's say, I don't know, 5 minutes, 10 minutes, something like that. How about we go for 5 minutes? Let's click OK. And so what we're left with, let me note here, what you're seeing is a bunch of gray boxes and a bunch of white boxes. What are those? What are these rectangles, gray and white? Well, on a traditional stock chart, we're used to just seeing the trading that happens between opening bell and closing bell during the normal market hours. When we go to an intraday basis, it will by default show the overnight or extended hours trading, pre-market, post-market trading. For some, though, since those are lighter trading, it may not be the hours that they trade. We can, if the trader prefers, customize the chart to eliminate that and just look at what's happening from opening bell to closing bell on a daily basis. Let's do that. Let's come up here and change our chart settings. Go to where it says equities. And down here where it says show extended hours trading session, I'm going to uncheck that. And this is going to look a little bit more traditional to some of you. There we go. So now we're just looking at just what happens during normal market trading hours each day. And a trader who's making the effort to try to refine their timing on a very short-term basis may want to see that even over a period of on an hour-by-hour basis, prices are going lower. And it looks like they have been. Prices have been coming down and down, making lower highs and lower lows, and that may strengthen their case, their technical case for their position. Now, even looking at a shorter term time frame doesn't guarantee that we're going to be right. But let's say that our trader's pretty happy with the scenario on the hourly chart, on the daily chart, and so now they want to go turn that into a strategy that might benefit within a narrow window with a bearish move against a bullish market. So how do we do that? Let me switch this back to a 1-year chart, just so I don't forget to reset that later. But let's go structure what we call a bearish vertical spread. Now, I've been very deliberately sidestepping calling it a bearish call spread or a bearish put spread because I haven't decided that yet. I'm going to show something that may help us decide between a call spread and a put spread. But let's go to the trade tab. And yes, we could set up a strategy that plays out over months or weeks. This one, we're going to go up to days. And we're going to be trading this 20th of July weekly, these weekly contracts that expire in just 6 days. Today's Tuesday. These are going to expire next Monday. So within a week, we're going to know whether this thing worked or not. So I'm going to open up the 20th of July window. And first of all, let's come down here and look at the puts. All right. So remember where our resistance was, 317.50. Now, if we're bearish, there are a couple of basic approaches. If we strip options right down to their most basic elements, we could buy a put or we could sell a call. Both of those are bullish strategies, or we could do variations on those two themes. So let's start with looking at things from the put side of things. If I were to buy, for example, a 320 put and the stock goes down, well, that trade might benefit from a downward move in stock price. And if I were to turn that into a vertical spread, so if, let's say we bought the 320 put, but we sold the 317.5 put, that would create a bearish put spread. What we would wind up with here is we would have the obligation. Somebody could sell us shares at 317.5. That's what happens when we sell a put. We take on an obligation to maybe have to buy the shares at the prescribed price. But we would also have the right to sell those same shares to someone else for 320. So if we got sold the shares at 317, we could sell those along for 320. That would be a 215 profit if this were a free trade. It's not a free trade, right? But this creates what's called a bear put spread. Now, some of you who are really familiar with options have probably already spotted a potential issue here. Just take a look at what's right there in front of you, right next to my cursor, and see if there are any maybe alarm bells that are going off. Yeah, some of you might have looked at this 320 put and said, all right, well, look at this. The spread between the bid price and the ask price is 85 cents wide on an $8 contract. It's over 10%. That's a big hole to dig oneself out of in 6 days, right? And at the 317.5, there's about a 35-cent spread between the bid price and the ask price. There's a big distinction between what buyers are paying and what sellers are receiving when they're trading these contracts. And when there's a big wide spread like that, it creates a hole for the trader to dig themselves out of. Let me just focus on the 320, for example. If we bought that 320 put and we just paid the ask price, it'd be about right now $835. And if we got immediate buyer's remorse and we went to sell and we sold at the bid price, we might retrieve $1,715 or $715 right back. Buy at $835, sell at $715. There's $120. That's $1.20 per share that we lost, and the stock hasn't moved. Nothing has actually happened yet. That's slippage. That's what we call that right there. So we have a concept of a trade, but we've already encountered an obstacle. Kevin is saying, is Theta working hard against it too? No, actually, Kevin, this one, Theta would be working, well, theoretically working toward the trade because of where we positioned it. For this trade to work out, we need the stock to be below 317.5 at expiration. It's already there. And if the stock didn't do anything and nothing but happened but time passed, we'd actually be working toward maximum gain. Time is working in the favor of this trade. But let's pop over here to the call side of things. And what you'll notice is much narrower spreads between the bid price and the ask price. Not nearly as much slippage. And we could use the same strike prices to set up a very, very similar trade. Yes, one's a debit, one's a credit, but reward and risk scenarios, probabilities of success and failure are all going to be very similar on these two trades. But the calls have much less slippage than the puts right now. That's not uncommon. Let me remind you what that chart looked like. Look what happened in the day. Oh, by the way, our candle just shifted to red. That's interesting because it was white just a moment ago. Guess which way this thing is moving as we're talking. Anyway, this was, how low were we just recently? We were down at $274 very recently, and then we rocketed up too. We shot up comparatively to other times, up to $323. So from 274 to 323, we're talking about basically a $50 move really quickly. Now, when a stock runs up that quickly, do you think anybody's wondering, oh, geez, maybe this thing will come down? maybe I ought to get some protection for this. Are there any traders out there who might be buying puts? Yep, after extreme moves like this, it's not uncommon to see a lot of action, a lot of activity of people trying to buy puts to hedge their positions. And there can be a strong imbalance between the demand for puts, people trying to buy puts, and people trying to sell puts. So when there's an imbalance like that, the market maker steps in as the seller, and that can create risk for them, and they tend to widen the spread between the bid price and the ask price. If you didn't follow that logic, that's okay. Just know there's a lot of slippage over here on the puts at the moment, not so much on the calls. So I'm going to pop over here to the call side of things, and we're going to create a bear call spread instead of a bear put spread. So how would we do that? Here's how a bear call spread is constructed. So here's going to be our example strategy. And this is for a short trade in this example. Starts with selling a call. That's the sort of the original premise of this trade was, do we buy a put or sell a call? And then make a variation on one of those two themes. So we're going to sell the 20th of July. Let's do the 317.5 call. And that looks like that's trading for between 205 and 212 right now. Let's say we're able to get to, let's not be too generous. I'll just say 208. I'm going to throw in the word here, 4 here. There we go. So if we just did that portion of the trade, what we're doing is we're getting ourselves into a contract where someone's theoretically paying us $2.08 per share, or $208 on these standard contracts of 100 shares. $208 being paid to us, but in exchange, someone has the right to buy shares from us for $317.50. Now, right now, they'd be overpaying for shares, so they're probably not going to do this today. But if shares rally, if they go to 330, 340, 350, maybe at that point they choose to buy our shares then at a discount. Now, what we're hoping for, though, is for the shares to just stay below 317.50. And that way, they're never purchased from us. The shares are never purchased from us. We just keep the $208 and time runs out on Monday for the other trader. But our stock may rally. At the same time we do this 317.5 call to complete our vertical spread, we're going to buy, same expiration, 20th of July, 6 days from now, we're going to buy the 320 call. Matter of fact, it's kind of grammatically incorrect for me to put a dollar sign there, so let me get rid of that one. We're going to buy the 20th of July 320 call for, that looks like it's trading between 130 and 138. We'll call it 134. So what does this do? Well, if someone else ultimately does decide to buy our shares for 317.5, we now have the contractual right. If we need those shares, we can buy them from somebody else for 320. It's damage control here. If we just sold this call and didn't buy the 320, now we just know that we might have to sell our shares for 317.5. We don't own any shares. We might have to pay 330, 340, 350. This gives us a contractually guaranteed purchase price on those shares if we need them. And to lock in that purchase price, it costs us $1.34. So we're giving away some of our credit here. So what's the net of this trade? Our net credit, also known as a theoretical maximum gain on this trade, is, well, whatever we collect minus whatever we spend. So that looks like that comes out to about 64 cents. Is my math right? Somebody check me. 74 cents. There we go. So we're collecting 74 cents. Doesn't sound like a lot, $74 on one pair of contracts here, but we're actually not, this also doesn't come associated with theoretically a very large risk. What's the maximum theoretical loss on this trade? How's that calculated? Well, if somebody winds up buying our shares at 317.5, and we have to go out and spend 320 to buy those shares, that would be a $2.50 loss if these contracts are ultimately assigned and exercised. We take a 250 hit, but we did get a credit up front. So what's our actual exposure to risk here? It's going to be a little bit more than $1.75, $1.76. Again, check my math. Let me know if I got anything wrong there. But yeah, this trade, theoretically, most we can lose is $1.76 within these next 6 days. Most we can make is 74 cents. So what's our return on risk? Let me show you. If we make $74 while we're tying up 176 bucks, this trade is offering about a 42% return on risk in 6 days. All right, so these are relatively big return numbers, but also big risk that we're taking here. We could lose more than we could make on this trade. That's typical in the nature of vertical spreads. When we're trading a vertical spread that has a higher probability of making money than losing money, typically there's a lower reward compared to the risk. So that's it. There are the trade details. Now let's talk about trade management for just a moment. We have this little window. We're trying to optimize our potential for return, but maybe also simultaneously attempting to minimize the risk. The risk, yeah, if this thing blows up, we lose 176 bucks. Maybe there are plenty of portfolios out there that might be able to just absorb that. But as a ratio, let's talk about how a trader may decide to manage this trade further. First of all, in the effort to optimize this, the amount that they can make, they may plan to just try to catch it all, or at least the majority of that 74 cents. So with this narrow window, let's say that at the least, we'd like to get at least 80% of that 74 cents. So how do we realize a gain on a vertical spread? Well, if we let it go to expiration on this credit spread, if it just expires worthless, that's one way to do it. That would make us our 74 cents if that's the outcome. Or we might have a plan to try to get out before expiration if we can do it inexpensively compared to how much credit we originally received. So here's the math on this. If we're trying to retain 80%, and I'm just using that as an example, just to emphasize that we're trying to optimize, trying to get as much of this credit and keep as much of this credit as possible. Let's say 80% is going to be our hypothetical trader's threshold. Then we can only afford to spend 20% of what we've collected. What's 20% of 74 cents? 10% would be about 7 cents. 20% is going to be about 14 or 15 cents. If you want to see it on a calculator, we take 74 cents, multiply that by 0.2. That means we can spend, right about 15 cents. So let's make a mental note of that. Let's say exit at 15 cents. I want to show how we can set that up as an order. Now our loss, though, we have sort of the opposite motivation. We could lose as much as $1.76 if we just let this go and it has its worst case outcome. But maybe our trader here is trying to cut that back. How do we cut the loss of $1.76? Well, we have to think about the motivations of this trade. We're collecting a 74-cent credit. We're hoping that goes down towards zero. We start to build a loss, though, if instead of the trade becoming less expensive to get out of it, it's becoming more expensive to get out of it. And with this trade, the greatest expense would be right at about $2.50. That's our sort of worst case scenario. And the calculation for that is if we collected 74 cents and the trade has become $1.76 more expensive to exit, that would be $2.50. So what we're going to do is let's have an exit. Actually, let me do this. I'm just going to rephrase this so it's a little bit more complete for you so you can read this. Exit at 20% of the original credit or 15 cents. With this, we're going to exit at, let's say we're going to cut our losses if we're halfway to our maximum loss. What's halfway of a $1.76 loss? $1.76 divided by 2 is 88 cents. Okay? So let me phrase it this way. We're going to exit at 50% of maximum loss, or how would we calculate that? Well, that would be 74 cents is what we collected, plus, maybe we'll put in another parentheses here, plus 88 cents. There we go. So what does this work out to be? 74 cents plus 88 cents would be $1.62. That's going to be when we'll just pull a plug on this. We were hoping to collect 74 cents and it goes down in value. If it's climbing and it gets up to costing us $1.62 to exit, we're going to pull the plug. That would be an 88-cent loss, or about half of what we originally gained. Or, pardon me, about half of what we originally had at risk. That's the $1.76. So yeah, there's a little bit of not always intuitive math in planning these trades. But let me show you how to put this into practice. I'm going to come up here to where it says spread single, and I'm going to change this to a vertical spread because that's what we're trading here. And let's look at our 317.5, 320 call spread. There it is. We were originally hoping for a 74-cent credit. Let's see if we can get that. Let's try to get 74 cents out of that. We may not get that. I'll tell you, that credit is shrinking, probably because the stock is going down further. It can make the call less expensive, less valuable in selling. Pretty close. Looks like we're more like 70 cents here. That's okay. It'll give us an opportunity to revisit our math. Let's try to get 70 cents out of this. I'm going to click on the bid price, and I'm going to put it in order to try to get 70 cents out of this credit spread. Now let's redo our math. All right, let's change our single order. We're going to put in an order to enter the trade, but then two other orders to take us out. One with profits, the other potentially with losses. Let's put in a first triggers OCO order. Our first order is going to trigger two exit orders. All right, so our first one, let's right click, create an opposite order. This one is to try to take profits. Well, if we only collect, let's say 70 cents, how much can we spend if we only want to spend 20% of that? Well, that would be 14 cents that we could spend as a limit on this trade. If we collect 70 cents and we spend 14 cents, hey, that allows us to keep 56. That's 80% of the original credit. Okay, Two Continents, One Island says, why not just exit when you've lost a premium received? That's a good question. Some traders might do that. In other words, it wouldn't just be I think this is your concept here. If we stand to make 70 cents, why don't we risk 70 cents and exit at, let's say, $1.40, right? Rather than $1.64 halfway to maximum loss, or $1.62 or whatever it was. That's a possibility, but the less wiggle room we give our trade, guess what happens to the probability of encountering that loss? Yeah, the probability of loss increases the less wiggle room we give the trade. So there are trade-offs. If we just leave it alone and allow for the full potential maximum loss, we actually have the strongest probability of avoiding taking that loss. If we say, you know what, I'm only going to give this a penny's worth of wiggle room, obviously I think that just intuitively means, yeah, we're probably going to take that penny loss, but it would just be small, right? Yeah, so there's a spectrum of wiggle room and probability of actually hitting the loss. That's it. So it's up to the trader to make that choice. But for our example here, if we collect a 70-cent credit, that would actually leave $2.30. Let's see if we can do the math. Pardon me, $1.80 on a $2.50 wide spread, if 70 cents is profit potential, well, 250 minus 70 leaves us $1.80 for risk. Half of that is going to be 90 cents. So if we collect 70 cents and then we spend another 90 cents to get out, where would our exit be? 70 cents plus 90 cents would be $1.60. Let's do that. Let's right click here. Let's create another opposite order. And this one's going to be a stop the bleeding. We're going to put in this at $1.60. Good till canceled. Stop the bleeding. I want out of this trade. If you want to reverse that logic, if we collect 70 cents and then we spend $1.60 to get out of the trade, that would be a 90-cent loss. Right? Sam says, it expires next Monday. You get 2 freebies on Theta over the weekend. Sam, yeah, that's true. As long as there's not some bad news that comes out about the company. Not a lot we can do about that, right? Not bad news, good news, causing the stock to go up. Bad news would be okay. This is a bearish trade. But that's going to be our example trade today. And so here's what may happen in the next 6 days. We might hit our profit exit and make about 56 cents. We might hit our loss exit and lose about 90 cents. Now, neither one of these is a guarantee that we're going to get to those. But let's confirm and send our order here. Selling this vertical, collecting 70 cents. We're going to buy out for 14 cents to take gains. We're going to buy out for $1.60 if we have to cut off our losses if the stock is rallying and the calls are becoming more expensive. That stop is not a guarantee that 160 is exactly where we exit. It might be 170, it might be 180, it might be more if there's a strong move. But there are commissions to be paid getting into the trade and ultimately getting out. And then we just send that order off. There we go. And it looks like we did, okay, we got 70 cents. Yep. So there we are. This will be interesting. How far do we need to get? We need to get to Monday right here. We just need to stay below 317.50. That's what we're hoping for. If the stock starts to rally, if the calls start to become more expensive between now and Monday, we have a stop order in place. There's one final thing I want to note is what if we rally up to just above 317.50, but we're still below 320? Well, in that case, if we hit expiration, we might wind up buying the shares, having the shares sold to us, effectively the same thing, but let's state it correctly. Someone has the right to sell us those shares for 317.50, and we don't sell them on to someone else for 320. We might wind up, I'm still in put mode. I tried to hurry to squeeze this in at the last second. We did a call spread. Yeah, if the stock is above 317, someone has the right to buy the shares from us for 317.50. We might wind up selling those shares and don't want to overpay to buy the shares back. We might wind up in a short stock position on Monday if we're between our strikes. So that's something we have to be aware of. There we go. All right, got it corrected. Anyway, but be aware that if we do wind up in a short stock position, that changes the reward and risk proposition entirely, because that is a trade that comes with unlimited risk. So be aware of that. But guys, we've accomplished what I set out to do today. I wanted to talk about trading narrow bearish windows in otherwise bullish market conditions. I don't know that that's exactly how the next few days are going to go, but let's just say our trader is convinced that we're going to likely stay below these recent price ceilings for just another week. Let's see if we can. Let's see. Sam says basic short-term credit spread assumptions bearish. Not sure what you mean quite by that, Sam. But yeah, the basic premise is we have a price ceiling. The trader's just trying to place a trade that benefits from that price ceiling in a short window. All right, everybody. Thanks for giving me your time today. It's time for me to let you go enjoy our other webcasts that we have coming up through the rest of the day. I also have other webcasts myself all throughout the week on a range of topics. But to enjoy those, here's a suggestion I have for you. Make sure that you're subscribed to our Trader Talks channel on YouTube. You can pop down below the video right now, click on the subscribe button. It only takes a second to do that. It doesn't cost anything. But our Trader Talks channel on YouTube, full title is Trader Talks Schwab Coaching Webcasts, is where you can join these live streams. You can also find playlists of previous webcasts. So for example, if you want to find other discussions that we've had in this Getting Started with Options series, go to playlists, scroll on down. This one happens to be right on down toward the bottom. There's my Getting Started with Options, and you can see the view full playlist right here. Last week, we talked about a beginner's guide to the power and peril of trading options. Interesting topic. You might want to go check that out. Now, Kevin and I would also like to issue an invitation to everybody listening, whether you're here live or you're watching on the recording, to follow your favorite Schwab presenters on social media. You can follow us on X. You can follow us on LinkedIn. Kevin can be found on X at Kevin Horner CS. You can find me on X at Cameron May CS. Here's my handle. And if you reply to one of my posts here, I just try to reply right back to you. For example, I thought it's kind of a funny comment here about a swing trading video that I did. But if somebody replies to that post, I just try to reply back. It allows for interaction when the camera's not on. Now you can also find and follow us on LinkedIn. Just pop over to LinkedIn to find me. It's just linkedin.com/in/Cameron May CS. All right. Give me a follow here. I post here. And if you reply to my posts, I try to reply right back to you. Guys, thanks for giving me your time. Thanks for all the thumbs up. I can see 116 people watching the live stream right now. 48 of you have already clicked the thumbs up. That's very much appreciated. It's a pat on the back to the presenter. It also gives my video a nice boost in the YouTube algorithm, helps more people find these webcasts. So thanks for doing it. And that applies to whether you're live or on the archive. But everybody, I will see you in a future webcast. I'll also look for you on social media, on X and on LinkedIn. But whenever I see you again, until that moment arrives, I want to wish you the very best of luck. Happy trading. Bye-bye.